Hey folks, I hope you're doing fine. I'm Simo from Investment Research, and today we're doing a complete deep dive comparison of two of the most popular ETFs in America, QQQ and IVV. Now, I want to give you a complete overview of these two funds so you don't have to watch 10 other videos or piece together information from multiple sources. If you listen to my analysis, you're getting the complete picture on performance, fees, risk, holdings, and most importantly, which one makes sense for your portfolio. This is one of the biggest debates in ETF investing, tech-heavy growth versus broad market diversification. And by the end of this video, you'll know exactly which fund aligns with your investment goals. Before we get into the specifics, let me give you the fundamental difference between these two ETFs because understanding what they track is critical. QQQ, officially the Invesco QQQ Trust, tracks the Nasdaq 100 index. This is the 101 largest non-financial companies listed on the Nasdaq stock exchange, and it's heavily tilted toward technology and innovation-driven businesses. The fund launched in 1999 and is managed by Invesco. IVV, officially the iShares Core S&P 500 ETF, tracks the S&P 500 index. This is 503 of the largest publicly traded US companies across all sectors, providing broad market exposure. The fund launched in 2000 and is managed by BlackRock through their iShares brand. Both are passive index funds, meaning they're not actively managed but simply aim to replicate the performance of their underlying indexes as closely as possible. Now, let me talk about performance because this is where things get really interesting. As of November 2025, QQQ is up approximately 23.5% year to date, while IVV is up around 21% to 22% year to date. Over the trailing 12 months, QQQ has returned about 30.7%, significantly outperforming IVV. When you look at longer time frames, the outperformance becomes even more dramatic. Over the past 5 years, QQQ has delivered a total return of 140%, meaning $1,000 invested 5 years ago would be worth about $1,000, $2,400 today. Over 10 years, QQQ has returned approximately 492%, which is an annualized return of about 19.6% per year. Over 20 years, QQQ has returned an astounding 1,792%, which represents an annualized return of about 15.8% per year. Invesco QQQ has beaten the S&P 500 7 out of the last 10 years as of September 2025, which demonstrates consistent outperformance during this tech-driven bull market. However, and this is critical, that outperformance comes with significantly higher volatility and risk. During the 2022 bear market, QQQ dropped 32.6% compared to the S&P 500's decline of about 18%. The nearly 5% gap in 10-year annualized performance between QQQ and IVV is significant, but it needs to be weighed against each investor's risk tolerance and investment timeline. Let me break down the sector exposure because this explains everything about the performance difference and the risk profiles. QQQ is built for growth with an extremely concentrated sector allocation. Technology represents a massive 64% of the portfolio, with consumer discretionary at 18%, communication services and healthcare making up most of the rest. This is not a diversified fund, this is a concentrated bet on tech and innovation. The top holdings include Nvidia, Microsoft and Apple, and collectively the top 10 holdings represent over 8% each in some cases, with Nvidia, Microsoft and Apple alone accounting for a huge portion of the fund. IVV, by contrast, provides much broader sector representation. Technology is still the largest sector at 36%, but weightings are far more balanced, with financial services at 13%, healthcare at about 11%, consumer discretionary at 11%, and meaningful allocations to industrials, energy, utilities, real estate, and consumer staples. Like QQQ, its top holdings are Nvidia, Apple, and Microsoft, but each makes up a smaller portion of the total portfolio. The portfolio holds 503 companies compared to QQQ's 101 holdings, providing significantly more diversification. This sector concentration is QQQ's superpower in bull markets and its Achilles heel in bear markets. When tech is leading, QQQ crushes the broader market. When tech sells off, QQQ gets hammered much harder than IVV. The concentrated exposure to mega-cap tech amplifies both gains and losses, which is why QQQ has a higher beta and higher volatility than IVV. Now let's talk about fees, because over long holding periods, even small differences in expense ratios compound significantly. IVV has an expense ratio of just 0.03%, which is incredibly low and makes it one of the cheapest ways to get broad US market exposure. QQQ has an expense ratio of 0.20%, which is still relatively low compared to actively managed funds, but it's 0.17% higher than IVV. On a $10,000 investment, that's an extra $17 per year, and on a $100,000 investment, that's an extra $170 per year. Over decades, these fees compound and can make a meaningful difference in terminal wealth. Dividend yield is another area where the funds differ. IVV pays a higher dividend yield, currently around 1.2% to 1.3%, which may appeal to income-focused investors. QQ pays a lower dividend yield of around 0.5% to 0.6% because the technology companies it holds tend to reinvest earnings into growth rather than distribute them as dividends. If you're in the accumulation phase and don't need income, this doesn't matter much. But if you're approaching retirement or want some cash flow, IVV provides more dividend income. Let me talk about risk metrics, because this is where you really see the difference. QQQ has higher volatility both in the short and long term, stemming from its concentrated exposure to technology and growth stocks, which tend to fluctuate more dramatically than the broader market. The standard deviation, which measures volatility, is higher for QQQ. The maximum drawdown, which is the largest peak-to-trough decline, was significantly worse for QQQ during the 2022 bear market. However, QQQ's Sharpe ratio, which measures risk-adjusted returns, is actually slightly higher at 0.99 compared to IVV's 0.87, meaning you're getting compensated for the extra risk you're taking over the past 12 months. The correlation between QQQ and IVV is 0.87, which is considered high, meaning they move together most of the time. This makes sense because both are US large-cap equity funds and share many of the same top holdings. However, having both in a portfolio doesn't provide as much diversification benefit as you might think, because they're highly correlated. If you own IVV, adding QQQ doesn't dramatically reduce your risk. It primarily tilts your portfolio more heavily toward tech. Now, let me address the assets under management, because this impacts liquidity and tradability. QQQ has approximately $330 billion in assets under management, making it one of the largest ETFs in the world. IVV has approximately $470 billion in assets under management, making it even larger. Both are considered high-volume assets with excellent liquidity, meaning you can trade them with minimal slippage and tight bid-ask spreads. Neither fund uses leverage or inverse strategies. They're both straightforward, long-only equity index funds. Let me talk about the top holdings in more detail, because this illustrates the concentration risk. QQQ's top 10 includes Microsoft, Nvidia, Apple, Amazon, Meta, Broadcom, Tesla, Costco, Alphabet, and Netflix. Notice that this is almost entirely mega-cap tech and growth stocks. If you believe these companies will continue dominating and growing, QQQ gives you maximum exposure. If you think they're overvalued or due for a correction, QQQ is going to hurt. IVV's top 10 includes the same mega cap tech names at the top, but also includes Berkshire Hathaway, Eli Lilly, JP Morgan Chase, and other non-tech names further down the list, providing more balance. So what's my assessment as an equity research analyst comparing QQQ versus IVV? QQQ is the aggressive growth option. It's for investors who believe that technology and innovation will continue driving market returns, who have a long time horizon of at least 10 to 20 years, who can stomach significant volatility and 30% to 40% drawdowns during bear markets, and who want maximum exposure to the companies driving the AI revolution, cloud computing, e-commerce, and digital transformation. If you're in your 20s, 30s, or 40s still accumulating wealth and don't need the money for decades, QQQ's higher growth potential can compound into significantly larger wealth over time. IVV is the balanced, diversified option. It's for investors who want broad US market exposure without concentration risk, who prefer lower volatility and smoother returns, who want higher dividend income for cash flow needs, and who believe in owning the entire market rather than making a sector bet. If you're approaching retirement, need more stability, or simply want to sleep better at night during market turbulence, IVV is the better choice. It's also the better choice for investors who don't want to worry about sector rotation. With IVV, you own everything, so you're never completely wrong. Here's my personal view on how to think about these two funds. If I had to choose only one ETF for the rest of my life, I'd choose IVV. The broad diversification and lower risk provide more certainty of positive long-term returns. However, I think there's a strong case for owning both in a portfolio with strategic allocation based on your age and risk tolerance. For younger investors in their 20s and 30s, a portfolio of 70% QQQ and 30% IVV tilts toward growth while maintaining some diversification. For investors in their 40s and 50s, a portfolio of 30% to 40% QQQ and 60% to 70% IVV balances growth with stability. For investors approaching retirement, a portfolio of 10% to 20% QQQ and 80% to 90% IVV provides mostly stability with some growth kicker. Let me address some common misconceptions. First, some investors think they need to pick between QQQ and IVV. You don't. You can own both. Second, some think QQQ is too risky for anyone. That's not true. For young investors with decades ahead, the higher growth potential justifies the volatility. Third, some believe IVV is too boring and won't generate wealth. That's also false. The S&P 500 has been the greatest wealth-building machine in history for patient long-term investors. Fourth, some think you should market time between these two, buying QQQ in bull markets and switching to IVV in bear markets. This never works. By the time you realize the market environment has changed, it's too late. Pick your allocation and stick with it. The key risks to understand with QQQ are sector concentration risk, meaning if tech underperforms, your entire portfolio suffers. There's also valuation risk, as many of the mega-cap tech stocks trade at high multiples. Interest rate risk matters because growth stocks are more sensitive to rising rates, and regulatory risk is present because big tech faces increasing scrutiny from governments globally. The key risks with IVV are lower growth potential, as it's mathematically impossible for IVV to beat the market since it is the market. You also have equal exposure to underperforming sectors, and during periods when tech is crushing it, IVV will lag QQQ significantly. Let me give you some real-world scenarios. Scenario 1, You're 25 years old with $10,000 to invest for retirement in 40 years. I'd put 80% in QQQ and 20% in IVV. You have time to ride out volatility, and the higher growth potential of QQQ can compound into massive wealth. Scenario 2, you're 45 years old with $200,000 to invest and 20 years until retirement. I'd put 40% in QQQ and 60% in IVV. You still want growth, but you need more balance and lower volatility. Scenario 3, you're 60 years old with $500,000 and approaching retirement in 5 years. I'd put 10% to 20% in QQQ and 80% to 90% in IVV or other diversified funds. Capital preservation matters more than aggressive growth at this stage. One final consideration is the tax efficiency of both funds. Both QQQ and IVV are extremely tax efficient because they're index funds with low turnover. They don't generate much in capital gains distributions, which is a huge advantage over actively managed mutual funds. If you're investing in a taxable account, both are excellent choices from a tax perspective. If you're investing in a tax-advantaged account like an IRA or 401k, taxes don't matter, and you can focus purely on the performance and risk characteristics. So what's the bottom line? QQQ offers higher growth potential, has outperformed over the past decade, and is perfect for aggressive investors who believe in the tech-driven future, but it comes with significantly higher volatility, concentration risk, and larger drawdowns during bear markets. IVV offers broad diversification, lower volatility, higher dividend yield, and rock-bottom fees. It's the safer, more balanced choice that's suitable for investors at any stage of life. For most investors, especially those who are uncertain or risk-averse, IVV is the better default choice. For aggressive growth-oriented investors with long time horizons, QQQ can be a powerful wealth-building tool. My recommendation is that if you're just starting out and confused about which to pick, start with IVV as your core holding. It's the S&P 500, it's diversified, it's worked for generations of investors. Once you have a solid foundation in IVV and you understand your risk tolerance and investment goals, you can then decide whether to add QQQ as a satellite holding to tilt toward tech and growth. But trying to go all in on QQQ without understanding the volatility and concentration risk is a mistake that many young investors make and then panic sell during the first 30% correction. Alright folks, that's my complete analysis on QQQ versus IVV as of November 2025. Both are world-class ETFs that have made millions of investors wealthy over the years. QQQ is the growth champion with higher returns and higher risk. IVV is the diversified market benchmark with lower risk and lower fees. Your choice depends entirely on your age, risk tolerance, time horizon, and conviction in the technology sector. For most people, IVV is the better starting point, but QQQ absolutely has a place in aggressive growth portfolios. As always, do your own research, understand your personal situation, and invest for the long term regardless of which fund you choose. Thanks for watching, and I'll see you in the next analysis.